It's Monday, January 5th in the garage, and the market is opening with intent. Bitcoin is trading at $93,800. Ethereum is holding near $3,180. Solana is sitting around $135. Those numbers matter because crypto is not reacting emotionally, it's reacting structurally. Over the weekend, the world absorbed a serious geopolitical shock with U.S. action in Venezuela. In past cycles, that would have sent oil vertical and risk assets scrambling for cover. Instead, crude is still hovering near $60, equity futures are composed, and capital is rotating, not running. This is a decoupling market. Defense and artificial intelligence remain in favor, while traditional fear trades are being ignored. But don't confuse calm with safety. Gold and silver are pushing higher, quietly signaling that institutions are hedging tail risk while staying long growth. Participation on the surface, protection underneath, and crypto continues to send its own message. Michael Saylor just added another 1,286 Bitcoin, spending $116 million while increasing cash reserves by $62 million. Total holdings now stand at 673,783 Bitcoin with more than $2 billion in cash on the sidelines. Volatility isn't a threat here. It's inventory. This is dollar cost averaging at an institutional scale. Zoom out and the plumbing is becoming impossible to ignore. There are now more than 130 crypto-related ETF filings sitting with the SEC. Bitcoin and Ethereum ETFs are already reshaping supply and demand, and momentum is building around Solana as the next logical expansion. 2026 is shaping up to be the year crypto fully integrates into traditional finance. And adoption is no longer theoretical. Walmart is now accepting Bitcoin for in-store payments. That's not a headline, that's infrastructure. Crypto is moving from charts to checkout counters. Each major retailer that accepts digital assets lowers friction, increases trust, and accelerates everyday usage across the ecosystem. Structurally, this market is clean. Bitcoin dominance remains elevated, altcoins are still suppressed, and leverage is controlled. This is institutional behavior, not retail euphoria. Capital is consolidating into quality and waiting patiently for the next expansion phase. Here's the risk. Markets are assuming containment. No escalation, no second wave. If that assumption breaks, repricing will be fast and unforgiving. The opportunity? Discipline. Buy panic, not hype. Favor assets tied to real liquidity, real adoption, and real balance sheets. It's a bullish but fragile start to the week. The lights are on, the track is warm, engine's hot, safety off, let it rip.